Welcome to the high stakes world of the Federal Reserve, where every word, every decimal point, and every political pressure could reshape your financial life. The new tariffs on China could send inflation rocketing by 2.2% overnight. Meanwhile, the Fed's trapped cut rates too soon, and prices spiral, wait too long, and millions drown in debt. And you're caught in the crossfire, whether you're applying for a car loan, renting an apartment, or just trying to afford eggs. This is Finance and Investment Hub, simplifying finance and investments for everyday success. What is the Federal Reserve? The Federal Reserve, or the Fed as most of us call it, is the bank of banks. It's not a bank where you deposit your paycheck, but rather the institution that sets the rules for how money flows throughout the economy. Their main jobs? Keeping prices stable, maximizing employment. Sounds like a big responsibility, right? And it is. By adjusting things like interest rates, the Fed tries to ensure that the economy doesn't overheat with skyrocketing prices or cool down too much, causing job losses. In short, the Fed is trying to keep our economic engine running smoothly. Understanding interest rates. Now let's get into interest rates. When you borrow money for a car, a house, or even on your credit card, interest rates determine how much extra you pay over time. Conversely, if you're saving money, interest rates tell you how much you earn on your savings. The Fed influences these rates by setting something called the federal funds rate. This is the base rate that banks use when they lend money to each other overnight. When the Fed raises this rate, the cost of borrowing increases for businesses and consumers alike. That means you might see higher mortgage payments or more expensive car loans. And if they lower it, well, borrowing becomes cheaper. But there's always a balance to strike, because rates that are too low can sometimes lead to other issues. The mystery of inflation. Next, let's talk about inflation. Inflation is basically the rate at which the prices of goods and services, everything from your morning latte to your monthly rent, go up over time. A little inflation, say around 2%, is actually considered healthy. It shows the economy is growing steadily. But when inflation gets too high, your dollar doesn't go as far, and that can put a real squeeze on your wallet. Even if your income increases, if prices rise faster than your wages, your purchasing power drops. It's like getting a raise and then realizing everything costs more, so your raise doesn't feel like much at all. How does this affect you? So you might be wondering, what do all these high-level terms mean for me? Let's connect the dots. Borrowing costs. When the Fed hikes interest rates, loans and credit become more expensive. That means higher monthly mortgage or car payments and even higher interest on your credit card bills. If you've ever felt that pinch at the checkout, that's part of the story. Saving and investing. On the flip side, when interest rates go up, you might earn a bit more on your savings in a high-yield savings account. But sometimes the increase isn't enough to outpace rising costs. Everyday prices. Even if the Fed successfully brings down inflation, it doesn't mean the prices you pay every day drop back to what they were in the past. Instead, you might just see inflation slowing down, meaning prices continue to rise, but more gradually. That can still make budgeting a challenge. Economic confidence. And here's a key point: public sentiment. When the Fed makes big changes, it's not just about the numbers. It's about what people expect for the future. If you hear that inflation is under control, you might feel more confident spending or even negotiating for a raise. On the other hand, if you're constantly worried about prices, that stress can affect everything from your spending habits to your long-term planning. Quan, what can you do? So, how can you navigate this sometimes confusing world of monetary policy? Here are a few simple tips. Stay informed. Even if you're not an economist, understanding the basics of what the Fed is doing can help you make smarter financial decisions. A little knowledge goes a long way when it comes to your budget. Budget wisely. Track your expenses and see where inflation might be hitting you the hardest, be it groceries, gas, or utilities. Small adjustments in your spending habits can add up over time. Plan for the future. If you're planning to take out a loan, consider fixed rate options. Fixed rates can protect you from future rate hikes. And if you're saving, look into accounts or investments that might offer better returns in a rising rate environment. Don't panic. Economic changes can be unsettling, but remember, the Fed's goal is stability. Short-term fluctuations might be annoying, but they're part of a bigger picture aimed at keeping the economy healthy.